Hello folks, it is Monday, September the 25th. It's about 6 p.m. on the East Coast of the United States. In this video, I'll be focusing on interest rates. And of course, we just had a Fed meeting, and what came out of that meeting is a pause. Rates were unchanged, but the expectation is that we will get at least one more hike this year, which means either the October or the November FOMC meeting, and then 2 additional hikes next year. And the dot plot, which I don't put a lot of, I think it's like throwing the chicken bones or reading the tea leaves. I don't put a lot of credence in the dot plot, but the dot plot is currently showing that at the end of 2024, so basically 14 months from now, interest rates will still be at the current level, which means, as I have been saying, we're not going to get a long-term pause. We're not going to get a pivot. Interest rates are headed higher for longer, and this was some of the verbiage that came out of this Fed meeting and expectations throughout the analysts is that rates are headed higher for longer. And so that is my theme for interest rates, higher for longer. And of course, what happened in the markets after the Fed meeting, we got a breakout on the long end of the curve, and we got strength in the US dollar, and stocks headed lower. And just think about stocks and the sentiment, in particular, the sentiment surrounding stocks, as investors accept that interest rates are headed higher and will remain high for a long period of time, and that we're not going to get a pivot, we're not going to get a long-term pause. As that sentiment around stocks and the acceptance of higher for longer sets in place, stocks are likely to go lower and perhaps considerably lower. I mean, remember that, historically, stocks are terribly overbought, overvalued. Stocks shouldn't be this high, basically. And so at some point, something will occur that will cause the stock markets to revert to the mean. And at this point, the mean is far lower than current levels. And so just something to keep in mind if you have a significant portfolio of stocks, you might consider diversifying, looking at other alternatives. And so anyway, this is the dollar in the daily time frame. And we can see that we're just having a sideways consolidation for what is that? Most of 3 weeks, just basically bumping sideways, support, resistance, and then this was today, got a strong breakout. And so anyway, the dollar has broken out today, broken higher, but very overbought. If we're looking here at MACD, we can see that these 2 prior peaks in MACD, that's the level that we're at right now. And, as I've said before, MACD is not bounded. MACD can go to infinity if it wants to, but quite often these prior highs and lows act as range boundaries. So anyway, very overbought based on MACD. Energy is very elevated, and this is an impulsive price bar where the price has closed near, not at, but near the high of the session. And so anyway, that is an impulsive price bar. So suggestive of higher US dollar in this time frame. This stocks, we're just going to look at this one chart. This is S&P 500 in the daily. I don't put a lot of credence into head and shoulders patterns, but those green arcs there, you might interpret that as a head and shoulders top. And of course, we've got stocks headed lower. Let's draw a neckline. See, we might throw a neckline oh, you know, something like that probably is where, yeah, I'd probably put a neckline right in there. And so we can see that we've had a decisive break, even got a gap. So got a gap lower from that neckline level, and then a fairly large bar to the downside. Currently, we're bumping along on this horizontal support from this prior high, and we're also on the lower median line of this shift pitchfork. So a couple of levels of support there, potential support, but certainly some bearish indications with that head and shoulders pattern and then that gap. So gaps to the downside, obviously that's bearish. MACD is in bear mode, meaning that both indicator lines are below the zero level. That suggests that the primary trend in this time frame is downwards, and then energy is low. So not a positive chart. If you are a stock bull, should have major support at the 200-day moving average if price wants to head that much lower. And if we throw in the next median line, yeah, and so we've got another median line extension down at that level. So anyway, that's stocks, could be headed lower. Now we're into the interest rate charts. This is yield on the 1-year bill in the monthly time frame. Currently just in a sideways consolidation, just bumping sideways. But note that we're bumping sideways at a high level. We're not getting a pullback. We're not getting a correction, just a sideways consolidation. And there's a lot going on. Boy, there's a lot happening. I'll do a longer video tomorrow. We'll talk about world events. But anyway, the world is continuing to move away from the U.S. dollar, U.S. Treasury debt, etc., which is one of the main reasons that interest rates will head higher and remain higher for longer. So yield on the 1 year, this is in the weekly time frame. Mostly sideways action for several months now, but there is a slight upward bias. And we can see that the 10-week moving average is providing support. Basically, this 1-year bill yield on it is just ticking higher along with the moving average. So energy is low based on stochastics, MACD in bull mode, currently on a sell signal. So, you know, not a strong upward movement on the short end of the curve, but trending higher regardless. And so here we've got 2-year Treasury note, in the weekly time frame. Again, break higher, testing support after the breakout level, and then pushing higher. Now this megaphone pattern tends to resolve to the upside. And so this is actually a bullish pattern. When rates break through this level, they're likely to do so decisively. You know, an impulsive bar. At some point, we're likely to see an impulsive break through the top of that pattern. MACD is in bull mode. Looks like, yeah, currently on a buy signal. Energy is elevated. So this vehicle is certainly in a bullish configuration. And then as we move further down the curve, now we're in the 5-year note, weekly time frame. We can see that last week and this week, we've got a solid breakout from this horizontal resistance zone. It's never been tested as support, so we can't call it a support resistance. All we can say is that it acted as resistance, you know, resistance, 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 and then finally a breakthrough. And that's where we're at now with the breakthrough this week. MACD in bull mode on a buy signal, energy very elevated. So this is a bullish chart suggesting that rates in this time frame on the 5-year are headed higher. And of course, we're pushing up towards the 5% level. Round numbers, it's human psychology. They tend to be significant. So, you know, bulls are targeting 5%. They'll take profits or close their trades there. Well, no reason to close trade, but take profits at that level. And then we'll get the bears coming in. They'll be selling that level. So likely that we'll have a reaction in this vehicle around the 5% level. But that's where I would, if I was betting on what's our target in this vehicle currently, I'd say 5% because it's a round number. And it's not that much higher. It's 10%. So 10% upside to hit that target. Now we're looking at yield on the 10-year weekly time frame again. MACD in bull mode on a buy signal, energy very elevated. Breakout, not only a breakout, that was last week. We got the break above this resistance zone. Now this week we've actually got a gap higher. So numerous bullish factors in the 10-year. 30-year, obviously, strong breakout and a breakout to, you know, it's not all-time highs, but breakout to, let's see, we have to go all the way back to 2011. So we have to go back to 2011 to find the last time that rates were this high in the 30-year. And so anyway, I just want to emphasize that we're seeing significant moves in interest rates, all of the U.S. debt instruments, and in my opinion, this is occurring primarily because most of the world is moving away from the U.S. dollar and U.S. debt instruments. And of course, the two go hand in hand. If they're not interested in the U.S. dollar, they're not interested in U.S. debt instruments. And what the banking system does, the U.S. Fed does, to combat that trend, to try to protect the banking system, is to increase interest rates. They're trying to attract legitimate buyers of U.S. government debt instruments. And you know, they want legitimate buyers because if they can't find legitimate buyers for their debt instruments, their only option is to crank up the printing presses and buy them themselves, which of course they're doing anyway. But when it becomes obvious that the central banks are buying their own debt instruments, that is perceived as banana republic behavior. And then, you know, that just sets off a downward spiral because, you know, if you weren't interested in investing in a economically healthy country, you're certainly not interested in investing in a banana republic. And so, in my opinion, the U.S. Fed will continue raising interest rates in an attempt to attract legitimate buyers of their debt instruments. Just out of curiosity, I want to look at, we haven't looked at this 30-year mortgage rates lately. 8%. Woo, doggies. Like I said, I hadn't looked at those in a while. So imagine what that does to the real estate markets with a 8% mortgage. I refied, God, I think it was in 2021 at around 3%. I think I was at 3 3/8 on a 30-year fixed, and here we are at 8%. So if you looked at affordability of, you know, my condo that I refied, I could afford less than half of that condo today based on current mortgage rates. And so anyway, reasonable to expect that along with stocks heading lower, real estate will also head lower simply because it's becoming unaffordable at these interest rates. So that's all I've got. This is just a short update. I wanted to take a look at interest rates after the Fed meeting. I've got a longer video coming up. Like I said, there's a lot going on in the world right now. We've had a G20 meeting, a UN meeting, a number of interesting things to talk about. But I'm going to wrap it up here. Look forward to talking to you soon.